Welcome and thanks for joining us on Berman's Call. Here to take your questions on both stocks and ETFs today. Here's how to reach us, 1-855-326-6266. You can also email your questions, Berman's Call at bnnbloomberg.ca. Larry joins us now to talk some more about what's been going on in the world. Trump, of course, threatened the EU only on Friday with a markup of 50%. That has now been delayed. Just wondering if you think these short pauses, in which case this one is going to be about a month, are a timeline even close to getting to some sort of agreement or forward-looking deal with the EU?
You know, Europe's a slow-moving animal, slower than any other bureaucratic entity on the planet, probably. So, you know, to get another deal done by July 9th, to me, is a stretch. Threatening more tariffs one day, rolling them back the next. The style persists. It seems like it is a bargaining chip in how Trump's delivering it. Markets are getting whipped around. But at the bottom line, when you hear from the C-suite, they all say, well, until this is clear, we just have to put our deal pens down and pause. And at some point, that's going to matter. But for now, the markets don't care. I remember weeks before COVID ripped through the world, markets were at all-time highs. The news was out there, it was percolating around, and U.S. stock market, nobody cared. So, you know, are we going to get another aha moment when we start to see a notable decline in the economic statistics, in particular the U.S. labor market? I think so. When is that going to be? That's the part that nobody knows and is adding to the complexity of what's going on right now. I think we're in the eye of the hurricane. You know, April 2nd, we had the first whip around. We're now in the middle of it. There's another one coming on the back end when this 90-day, window expires and we get into the July 4th big, beautiful bill. Are they going to sign it? What's that going to look like? So there's a lot of good coming. There's a lot of uncertainty coming. But until there's clarity, for me, it's hard to say the market can materially go higher from here. And I can argue why we'd see a little back in filling.
Okay, let's talk about NVIDIA as well. They're reporting earnings this week. They announced today they have a redesigned Blackwell chip that they're going to send to China. Is this going to be a big source of income for them?
Well, that's a good question. I don't know the answer to that in terms of what it means for their bottom line. I think the question is, what really is the U.S. administration's view here on wanting those chips made here and keeping China a second-class citizen in terms of artificial intelligence? I think when you look at some of the stuff coming out of China now, and they're talking about their next 5-year vision, which is a year from now, but they're starting the planning stage, converting their economy a little bit towards more consumerism, more domestic consumption. That's going to replace some of their former, trade. They're making their assumption that they'll pick up some trade with the rest of the world, but maybe against the U.S. it's going to come down because of this. I think China can play the long game here over the U.S. So it'll be interesting to see how this plays out in the coming quarters. But,
Also a July deadline coming up for China as well.
Well, it is. So there's a lot coming in the next few months. And again, market shouldn't be ripping higher here, certainly to new all-time highs. And I would argue for a bit more caution and some backing and filling from the excitement that we've had in the last few weeks.
What do you expect from NVIDIA with earnings? Again, they've been caught up in first what was like the tech crash at the start of the year. They've come back a bit, but then they had the China chips that have been sort of pushed back. Then they had some success in the Middle East with Donald Trump's trip there. So what do you expect for them in earnings?
So I look at consensus. And when you look at consensus, you say, what does the market think? And then you kind of make an estimate. Is this fully priced in or not? And of all the analysts that have upgraded their numbers prior to earnings in the last week, let's call it, we have targets from 140 up to 200. That's a pretty broad range. It's not crazy. It happens a lot. But this is a widely covered stock. There's 68 buys, 9 holds, 1 sell. So analysts are still universally positive. for the most part. Most of the recent price target moves have been slightly lowering numbers, not increasing numbers. So that's the market in front of us. So what needs to happen for this to break out and make new highs in the stock? What's going to need to happen for earnings for us to take out those 150 resistance? It's got to be stellar, and we can't be worried about China. I don't see it.
Yeah.
Right? Yeah. So where is it going to come back to? So again, like the broader market, maybe some backing and filling here. Doesn't mean we're going back to those lows, but we will go back to those lows if we get the hard economic scenario play out, but we need to see how the tariffs play, and that's months and months and months still.
Got it. Okay, we are going to line up some phone calls and emails for Larry. Here's the number again, as well as the email address. If you have a question for us, we're back in a moment. Welcome back to Berman's Call. We're here with Larry Berman. Let's get to an email from Noldy. He says, "Hi, Larry. I own Sprott Physical Silver Trust. Is this just as secure as having silver in a private vault, or is this closer to paper silver? Can you differentiate between the two?"
So the Sprott Physical Silver, they own silver. It's in a vault, and you're entitled to swap your ETF shares into physical silver. It's a process. No one's really ever going to do that. But is it as good as having silver bars in your safe in your basement or in your safe deposit box? So the question is, why do you want to own silver bars, right? We're never going back to a world, I hope, where we need to hold physical gold and silver because Mad Max has shown up, or the world's in disarray and nobody trusts the paperback currency. So if you believe that that's the world, well, no, because the exchanges will shut down. You won't be able to get your money out. So it's not as good as owning the bar, but it's that. That's far away. It's as close as you can get, and it's a quality ETF. And I love silver at this point. But again, it sounds by the type of the question it is it as good? And so the answer is yes, except for
that tiny slice
of the world going to pieces and the markets are closed and you can't do anything.
Why are you liking silver at this point?
I like its use in electrification of the world. So I think there's a demand for that. I like if we're in an inflationary environment, silver's price relative to gold has a lot of catch up to do. So to me, it's very attractive. Those are the two components that I'm looking at. And we've got positions in silver producers that we like a lot here. We think there's considerable upside.
Got it. Let's go to the phone lines. Andre's calling from Chilliwack in BC. Hi, Andre.
Oh, hi, Marella. Thanks for taking my call. Larry, very quickly, since the tariffs from Trump on steel and aluminum and cars, everything is down, I know, but the TSX has just crossed 26,000. It seems to be bullish. Please, could you explain who's buying into this market on the insider level? Do you believe that the trend is still our friend? Do you see it going higher? And where do you see the TSX going this year? It seems to be breaking out. Thank you, both of you. Bye-bye.
Thanks, Andre.
Yeah, so, when you look at the Canadian market, of course, you've got the big life cos and banks that make up a huge part of the index, more than a third. And then you've got the energy names, and then you've got some miners, a bunch of others too. So when you look at the new high here and you say, what's the catalyst to keep it going? You've got to have a very strong Canadian economy. And I don't see it relative to the U.S. I think we have a lot of longer-term structural weakness. So I wouldn't be expecting this trend to continue in a very robust way. And I'd probably be lightening up a little bit. Having said that, there is a move in the world where money is coming out of the U.S. in general and going into other places. So that's the opposite argument. Is that going to continue, and for how long? You look at the Canadian dollar relative to the U.S. dollar. What's the direction of that for the next few years? So, all things considered, let's call it neutral, but I don't think this trend is going to continue in a very, very strong way. Canada is relatively cheap compared to the US large cap market. So you got all these things combined. I would much rather buy into weakness. I am concerned the energy markets stay weak. Trump wants low oil prices. Low oil prices are good for the inflation story, and that's one of his best tickets. I think his trip in the Middle East recently is going to put a lot of pressure on the Middle East to pump, and keep prices lower for now. Once we get through the U.S. midterms, I don't think he cares, right?
Yeah.
Keep inflation low for now so that he can do all these other things that are inflationary. And so that, in theory, should keep the energy part of the Canadian market contained, and that's a bit of a cautionary one there too.
Got it. Okay, let's go to the phone lines from Joe is from Montreal with his question today. Hi, Joe.
Hi, Larry. I want to ask you about ZWK, which is the BMO U.S. Bank Dividend ETF. After Trump got into the White House, that really went down. I'm in a loss position in my cash account. I'm retired. I wanted to get your opinion about, with this big, beautiful bill, what does TRECO have on the ETFs that invest in U.S. banks? Thank you.
Thanks for the question.
Yeah,
okay.
so there's a lot of talk about less regulation for the banks, and then them freeing up some capital to grow and do some other lending. So I think that that's a positive. When you look at the U.S. banks as a group, ZWK, this is with a covered call overlay. ZBK is the pure U.S. bank play. It's underperforming a little bit. And part of that is to do with what's happening in the bond market and concerns over the Treasury refunding. And so a little bit cautionary. If we go into a hard economic landing, the banks are not beautiful, right? So is that coming or not? We have to see what how Trump does this. And he is such a master at keeping people off balance. I'm finding it very difficult to try to figure out what his end game is here. I know he doesn't want lower stocks, and I know he'd like a more robust economy and strong economic growth, right? So ultimately, that's bullish for banks. But are we going to have another negative first? And I think yes, before all those positives play out, looking out 2 or 3 years.
Yeah, got it. Okay, let's get to Ken. He's on the line from Vancouver today with his question. Hi, Ken.
Hi, Larry. I'm wondering if you could explain to me this BMO ETF ZAAA for income and stability, volatility, and safety, and maybe compare it to ZST. Thank you very much.
Yeah, so completely different animals.
Okay.
So if you look at the collateralized loan market, this is what you're getting exposure to in the U.S. There are some ETFs that have been out for a number of years that play in this space. The one that's the equivalent to this in the U.S. is JAAA.
Okay.
Maybe we can pull up a chart of that to have a look at. You have a couple considerations here. You have some credit risk that you need to be concerned about. ZST is basically like a corporate money market fund. And so they're very different vehicles. One has, it's not significant credit risk, but it plays the more complex part of the credit market. But it's a great instrument.
Okay.
I would say ZST, you're a lot safer in terms of your yield, in terms of your credit risk. What you would see if you brought up JAA,
we don't have.
Yeah, we don't have the chart of that right now. But what you would see is as you went through business cycles, when the markets are at risk, so credit risk, equities falling, you're going to see as JAA fall a little bit. So there's some credit risk there, but it's not like, oh my God, like a high yield bond, for example, because these are shorter term instruments, and you don't have a lot of longer term interest rate risk with them.
Okay, so we hope that answers Ken's question. Let's move on to Nazar, who's calling from Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Larry. May I have your thoughts on Canadian banks, please? They have started reporting. Would you wait before you buy? And I just heard your comments on BMO covered call U.S. banks ETF. Do your comments regarding BMO U.S. banks apply with to Canadian banks as well? Thanks for taking my call.
Okay.
Yeah, it does. In fact, today's educational segment, just coincidentally enough, is about the Canadian banks and how to play them with the either straight up equal weight or a covered call. So I'll go into that in the educational part of today's show. But the same thing applies. If you're concerned about the economic outlook and you think it's fragile and you think tariffs are going to be a problem, then, you know, the banks are going to take a harder hit if the economy slows down than other parts of the Canadian market, consumer staples, for example, supermarkets. So I'm cautious right now. I like them on the dip. We actually added on the weakness in April, but I've got out of those again. So as a tactical trader, we kind of do those things in the portfolio. And so I'm a bit more cautious, notwithstanding the recent earnings we've gone through. The risk return right here is more skewed towards cautionary outlook.
Got it. Okay, let's get to a quick email here from Rick. He says, hello, I'm looking at parking money for the short term in a high interest savings ETF. Is it the safest place to park money while we wait to see how the tariffs are going to affect the economy? Other than BOC lowering interest rates, what other factors would cause a lowering of the dividend?
Okay, so I think a lot of investors miss the fact that they changed these radically in the last few years. These high interest savings ETFs used to pay a big good premium over a money market fund. Government got rid of that because they used to have exposure to the mortgage market that gave it a little bit of an extra boost without an extra risk. And they changed the rules about a year ago. And if you look at what the best performing money market is, it's no longer these high interest savings account ETFs, all of them.
Okay.
Best one out there is ZST. And I've said this for quite a while on the show here for the last year or so, that dynamics changed. So if you're looking for a safe money market, the highest yield possible, ZST is going to give that to you over any of these high interest savings account ETFs that should probably have their names changed.
What's the yield for ZST?
So you look at what the government of Canada is paying for T-bills. So that would be your traditional money market fund. So these are corporate bonds that are under a year. So if you think about, well, what's that extra credit risk you're taking? 20, 30, 40 basis points in that range is going to be how much more you get than you would get in a Canadian money market fund. So if a Canadian money market fund is paying 260 right now, these high interest ETFs are maybe 270, ZST is going to be around 3 or 310, right? So that's the difference.
Got it. All right, we are going to take a quick break. When we come back, Larry's educational segment. We're back in a moment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. Larry Berman is here, and it's time for his educational segment. What are we learning today?
We get a lot of questions on covered call ETFs. Everyone wants the extra yield, and these are great products, but they work better in some environments than others. So you generally have a handful of different, we'll call it regimes or environments for the market where they tend to be a bit better. So they tend to be a bit better when you think the markets are going to go down for some longer period of time.
Is that 6 months to a year?
6 months to a year.
Okay.
Right, sure, let's call it that. And typically, if you look at the average correction, it's about 8 to 10 months. So that's about right in terms of a broader market decline. When you look at rapid decline, so COVID, in 3 weeks, it falls 35. You don't get a lot of protection, you get some, but it's de minimis.
Okay.
But in a strong up market, you're giving away the upside because you've got this covered call, and while you're getting the extra yield, you're lagging significantly. Now in the BMO world, ZEB, equal weight bank ETF, ZWB, equal weight bank covered call, going back to inception in 2011, just owning ZEB, the underlying one, the average investor, if they bought and held the whole time, got 10.71% annualized. If they bought the ZWB, they got 8.34.
Okay.
And there's an extra 43-ish basis points of MER. So if you look at the different dates here, and we're going back to 2011, during periods of strong rallies, so I'll highlight all the strong rallies here, you can see the huge difference in performance. So I love when you're cautious on the market, use the ZWB defensively. And at some point after a correction, 10%, 15%, go into the actual one where you get all the upside when it comes back. That's how you must use these things. Just using the covered call, looking in the newspaper and saying, oh, I get a higher yield there, I want that one, you're going to underperform in the long run.
Okay.
So these are great vehicles. They cost a little bit more. They give you a little bit of protection. When you look at some of these periods of strong declines, so here we have this year. Market sells off first few months. Look at that extra difference, couple basis points, no big deal. Look at the strong decline here in 2022, 2023 period. How much did you benefit? Not a lot. But when you look at the strong rallies, again, you must be in the ones where, sorry, that's not a strong rally, that last one there. It must be in the one that gives you all the upside after a correction. And that's really the message here.
And that was 2020?
So in the 2021, you had a strong decline, but during COVID, it came down so fast, you only saved about 31 basis points.
Okay.
Right? Because it happened so quickly. So the covered call overlay, that extra yield, didn't give you the time to pay off, right? If the decline takes a long time, it's better. So here's the price return, total return of the two of them.
Or less.
Yeah, here's the two of them. You can see the difference over time, that the underlying one gives you a much better long-term experience than the ones with the covered calls. But they do have a place in the portfolio in the right regime.
All right, we got to leave it there, Larry. Thanks for coming in. We'll talk again next Monday. And thanks for joining us. We'll see you soon.